Investing is not about getting rich or playing the market. It's an essential part of achieving financial wellness. That means being able to meet your needs and the needs of those who depend on you, as well as being able to set and achieve goals that go beyond merely being able to pay your bills and manage debts like mortgages, credit cards, and student loans. These 6 steps can help you increase your investing success and achieve financial wellness, even when financial markets seem unfriendly. 1. Start with a plan. Financial planning doesn't have to be fancy or expensive. You can do it with the help of a financial professional or an online tool like those in Fidelity's Planning and Guidance Center. Either way, making a plan based on sound financial planning principles is an important step. 2. Stick with your plan, even when markets look unfriendly. When the value of your investments falls, it's only human to want to run for shelter. But the best investors don't. Instead, they maintain an allocation to stocks they can live with in good markets and bad. The financial crisis of late 2008 and early 2009, when stocks dropped nearly 50%, might have seemed a good time to run for safety and cash. In the decade following the start of the crisis in June 2008, those who stayed invested saw their account balances, which reflected the impact of their investment choices and contributions, grow 147%. That's twice the average 74% return for those who fled stocks during the fourth quarter of 2008 or first quarter of 2009. While most investors did not make any changes during the market downturn, those who did made a fateful decision with a lasting impact. More than 25% of those who sold out of stocks never got back into the market and missed the gains that followed. If you get anxious when the stock market drops, remember that's a normal response to volatility. It's important to stick with your long-term investment mix and to have enough growth potential to achieve your goals. 3. Be a saver, not a spender. While it's easy to get caught up in the ups and downs of the market, it's also important to think about how much of your income you are putting away for the future. Saving early and often can be a powerful force when it comes to making progress toward long-term financial goals. 4. Be diverse. Fidelity believes one key foundation of successful investing is diversification, owning a variety of stocks, bonds, and other assets, which can help control risk. Having an appropriate investment mix, giving you a portfolio that delivers growth potential with a level of risk that makes sense for your situation, may make it easier to stick with your plan through the ups and downs of the market. Diversification cannot guarantee gains, or that you won't experience a loss, but it does aim to provide a reasonable trade-off between risk and reward. You can not only diversify among stocks, bonds, and cash, but also within those categories. 5. Consider low-fee investment products that offer good value. Savvy investors know they can't control the market, but they can control costs. A study by independent research company Morningstar found that, while by no means guaranteed, funds with lower expense ratios have historically had a higher probability of outperforming other funds in their category in terms of relative total return and future risk-adjusted return ratings. 6. Don't forget about taxes. Another habit that may help investors succeed is keeping an eye on taxes and account types. Accounts that offer tax benefits, like 401ks, IRAs, and certain annuities, have the potential to help generate higher after-tax returns. This is what investors call account location. The amount of money you put into different types of accounts should be based on each account's respective tax treatment. A related concept is called asset location, the practice of putting different types of investments in various types accounts, based on the tax efficiency of the investment and the tax treatment of the type of account. Bottom line? Investing can be complex, but some of the most important habits of successful investors are pretty simple. If you build a smart plan and stick with it, save enough, make reasonable investment choices, and be aware of taxes, you will have adopted some of the key traits that may lead to success.